Right, now we move on to our last topic, accounting for partnership. So after completing this chapter, you are able to explain the partnership characteristic or characteristic of a partnership. Number two, you are able to prepare capital account, current account, and also the financial statement of the partnership. And number three, explain the accounting treatment for asset revaluation, goodwill, if there is a change. This one is only theory. And then incorporate changes in partnership in the account, current account, and financial statement. This also is only for theory, for your required theory for your syllabus. So our introduction, so partnership exists when two or more people agree to pool money, skills, and other resources and share profit or loss in accordance with the partnership agreement. So it means that here one or two individuals are agreed to combine together to share their money, their expertise, and everything to form a partnership. So in Malaysia, partnership is defined as the relation which subsists between person carrying a business in the common view of a profit. So it means that they have the same interest to ensure that the business is going to get a profit. So a partnership may be formed in various ways. Number one, at least 2 and maximum of 20. Alright, 2 to 20 persons. And then the amalgamation of two or more sole proprietorship to form a business. For example, Abu Trading and Ahmad Trading, then they will become Abu Ahmad Partnership, right? So it means that two sole trader now become one partnership. Right, so where a sole proprietorship decide to invite another person. So it means that yeah, you already have your own business, but you need someone else to help you. And then you can invite another person to become a partner. So various reasons why the partnership is formed in the business. Number one, they can raise more capital because individual capital for sole trader is quite limited. So they would like to invite another partner to join in. So it means that they will bring in more capital. Alright, number two, the partnership creates a competitive advantage as expertise among the partners. So it means that here, if they join your business, they get another skill or something else that they can contribute. And then the partnership allows better management of the business because once they have this kind of the operation, they are able to manage day-to-day operation. So it means that here in better management because they have more partners. Alright, so basically we have three types of partners. Number one is general partner. So what is the general partner? The general partner is fully participating in the operation and managerial functions, right? And the partner also, the other keyword is they have the unlimited liability to the debt of the business. Right, general partner, they fully participate in operation and management, and they are also have the unlimited liability. What about sleeping partner? Sleeping partner is they do not participate in operation and managerial, but they is actually the same thing, fully liable for the partnership debt. And the limited liability partner is actually who has the option to take part. So they have the option to take part on the managerial function. So it means that if they would like to take part, they can take part. If they would not take part in the operation, they also may not take part. But what happened here is they are not legally liable for the debt of the business beyond the amount of the capital invested. For example, here is Mr. A invests 20,000 and Mr. B invests 40,000. So Mr. A is only limit for 20,000 and Mr. B can only limit to 40,000. But they should have another partner to make sure that the other partner will liable more than the amount that they contribute. Alright, characteristic of a partnership is number one is formed to make profit. And then number 2, minimum is 2 members and maximum of 20, but for professional, maximum up to 50 members. So professional, some sort like a lawyer's company, accountant's company, and so on for the professional partnership. So each partner is an agent to the other partners in the partnership. So his action to the partnership will legally bind the partnership and other partner. So it means that here what the other partner do is actually will affect the other partners. So each partner is responsible for the liabilities of the partnership as long as he still remain as a partner. So next, partnership is dissolved automatically when one of the partner dies. So this is his descendant has the right to share his share in partnership and can be admitted as a partner to the partnership with the agreement from the other partner. Right, next one will be the partnership can be distributed in any way that agreed by the partner. So it means that if they are agreed among themselves, so they can use in the partnership. So remuneration on drawing, partners could be arranged in any way as agreed by the partners. So here remuneration and drawing, so it means that if they would like to pay salary or any drawings taken by the partner, they would like to have something in the agreement also can. So advantages of partnership, number 1 is a greater pool of capital. So it means that here if only one person, so the capital is quite limited. But this if in partners, so it means that they have a pool of capital. So it means that here the capital can be more bigger capital. So it means that more capital can be raised and invested into the partnership because they have more people. Alright, number 2 is flexibility. Why flexibility is actually partnership is easier to form, manage and run compared with the companies. And then the other one is the management have the full control of the business. Number 3 is shared responsibility. So it means that here if the partners is having their partnership, so they can share the responsibility of the partnership in terms of the business operation, and then they also can contribute their skill, knowledge and expertise. Number 4, better decision making because they can help each other in making a decision. Disadvantages is number 1, disagreement. So it means that here partners would like here to have a different ideas how the business should be operated. Of course, if we have Mr. A and Mr. B, they have a different thought. In order to get the final decision is quite difficult. Alright, number 2, complexity in decision making. So it's quite complex for them to make a decision if time consuming. So it means that in order to discuss rather than if you are alone, you can make your own decision. Right, and then unlimited liability. So all partners are subject to unlimited liability where each partner share the liability and financial risk of the partnership. So it means that here your liability is unlimited until you have to sacrifice your private assets. Unfair profit sharing. So it means that here, according to the Partnership Act 1961, profit sharing should be equally. So if the profit sharing is distributed equally, sometimes it's not going to be fair to the other partner. Alright, so this is the partnership agreement. So it means that here you can state the clause that you want in the agreement. So what you want in your agreement. So what you should have in your agreement, number 1 is your name of the partnership, and then the date of commencement, so when you establish the partnership. Number 3 is capital contribution by each partner. For example, A contribute 10,000, B contribute 20,000 and so on. And also they have to state the profit sharing ratio. If they do not state the profit sharing ratio, so the act will apply where the profit will be divided equally. It doesn't matter how much that you contribute. Alright, next one is arrangement to the partner's drawing, interest on drawing, and partner salary. So it means that here, if one of the partner take drawing, if they would like to charge the amount that they took from the drawing, so it means that here, the more you take out the business money, you're going to have to pay more to the business. And then interest on advance, so it means that here interest on loan, so how many percent that you would like to pay back to the partners. And then interest charge on capital contribution, so it means that here if A contribute 10,000, so what is the benefit that you would like to give back to Mr. A in return, just like to say thank you for providing the capital to the partnership. So they can state in the agreement. Otherwise, if they do not state all these things, you are not allowed to get anything. Alright, so provision, admission of a new partner, death and retirement. So it means that everything should be stated. Otherwise, it's not stated, so it means that your partnership will be dissolved. And then methods of valuing goodwill upon retirement and death. And then provisions of the dissolution of partnership. Otherwise, you have to dissolve your partnership if there is a death and bankruptcy of a partner. So in the absence of partnership agreement, so it means that here, if you do not have your own agreement among the partner, so the act will apply what you should have to implement in the partnership. Alright, number one, if you do not state in your agreement the profit sharing, so the act will apply, they're going to divide it equally. And then if you do not state about the salary, no one is entitled for the salary and also interest on capital. Same also with the interest on drawing. So interest on drawing here, if one of the partner take drawing from the business, it means that there will be no charge on the drawing. Alright, advance loan from a partner in excess of the amount of capital is entitled to 8%. So it means that here, if one of the partner give loan to the partnership, some sort like previously if you learn from a topic of sole trading, so it means that you borrow loan from a bank. But this one, you borrow loan from a partner. So if you do not state anything in your agreement, so it means that the act will give you 8%. So next one, every partner may take part in the management of the business. So it means doesn't matter what, all the partners are entitled to take part. Alright, admission of a new partner must be consent of all the existing partner. For example, A, B, C raised D in partnership. Now they would like to admit D as a partner. So the A, B, and C should all of them agree to admit D as a new partner. Next one, the partnership book must be kept at the place of the business. So all the books, accounting record and everything should be kept at the place of the business where all the partners are entitled to access. So it means that you couldn't hide from the partners. Alright, accounting procedure, how to record the accounting procedure. Number one, for the capital contribution. Alright, so just like normal, we debit partner and we credit capital, but we have the name of the partner's capital account. Alright, so there are two methods of recording capital. Number one is fixed capital account. Number two is fluctuating capital account. Now we see what is the difference between the two. Alright, fixed capital account, so it means that they have two sets of account. Number one, they have the partner capital account, and the other two, they have the partner's current account. So two separate account, the partner's capital account and the current account. So this one, you're going to record any capital contribution from each partner. So additional capital should be credited, and then any reduction should be debited, just like normal, right? So it means that if they increase the capital, we should credit. All right, have a look here. So this is the balance brought down. So but the difference here is if we have two partners, So we have partner 1 and partner 2, partner 1 and partner 2. So previously we just have only one column, right? But this one, if two partners, then you should have two columns. But if you have three partners, then you should have partner 3 over here, right? So it depends on the nature of your partnership. So if capital is increased, you are going to credit capital, right? If the capital reduce, so you are going to debit your capital. So capital account is normal, but we have the name. The first one is for the partner's capital account. All right, current account. Current account is actually to record the profit, right? But now, since we have a few partners, so we have to record all the adjustment of the profit, right? So this one is related with the profit but not movement of the capital. So account is debited with the amount of drawing. So it means that here, if the partner took the money from the drawing, took money from the business, so the drawing should be in your current account but not in your capital account. So interest on drawing, share of losses, and credit amount of interest on capital partners, salaries, loan, and everything will be in the current account. We are going to discuss later about all those things. Right, so have a look on here. Is actually we have the partners current account, or in other term is actually the profit account for the partners. So what we have over here, balance BD for each of the partner, interest on capital, salaries, interest on loan, share of profit. So this one, all the item that will increase the partner's profit. But this one will reduce the profit of the partners. Okay, we discuss later on all of these items. And please bear in mind, we should have two columns if we have two partners. Alright, what about fluctuating capital account? So fluctuating capital account, they don't have the current account. So what they have is only capital account. So what they should have, the capital account should consist of the capital and plus with the transaction drawing, salaries, interest on loan, interest on capital, and interest on drawing. It combined together. Alright, so this is on the capital. This is if the capital is increased. Interest on capital, salaries, interest on loan, share of profit. Previously, this one is on the partner's current account, but now it joined in under capital account. So that is the difference. Same also with this one, interest on drawing and drawing. Basically, if under first situation, so it means that they are going to split between their capital and the current. But now fluctuating capital account, they are going to combine. Alright, treatments for other accounts. So it means that these are the things that we should know. Loan or advances from a partner. Alright, so for example, this is the partners. Alright, and this is the partnership. Okay, loan or advances from the partner. So it means that here the partner give the partnership, for example, loans. Okay, so loan or advance made by the partner to the partnership is considered as outside liability. Or previously, if we would like to understand some sort like bank, the same treatment. Alright, so the same situation, but in a partnership, but the partner give loan to the partnership. So what will be you are going to do here? So the amount will be credited to separate loan account. Okay, so what you should have, if the partner give the loan to partnership, so you should have the interest, you should have the loan from the partner. So previously you have the account loan from MBB, for example, right? But now you should have loan from partner A. Okay, so if they have the T account. Alright, in the event of dissolution, so it means that here the company would like to close up. So loan must be repaid before the preparation of the partner's capital and current account. So it means that here if they would like to dissolve the business, the first thing they have to pay on the loan first, because loan is their liability. So in the absence of the partnership agreement, such loan is entitled to 8%. Even though you do not state everything in the agreement, so it means that here you entitled to get 8% of your amount loan that you give to your partnership. So how to record interest, how to record loan? Alright, number one, credit loan, debit cash. Alright, and then how to record the interest on loan? So this is if the paid, so debit interest on loan expenses, credit bank. If the interest is not yet paid, debit interest on loan account, credit partner's current account. Alright, and this is if we would like to close our entry. Normally your final exam question will stress on this one as additional information where the interest on loan is not yet paid. Alright, partner salary. So it means that, please remember again, if you do not state in your partnership agreement, you are not entitled for the salary. But if you want to have a salary, for example, you don't have money, so you need the salary for you every month, so it means that you have to state in your agreement. So partner salaries are considered as an expenses for the partnership. So this one will be charged to profit and loss appropriation account, right? So P&L appropriation account is actually after the profit and loss account. So after profit and loss, so you should have the P&L appropriation. Alright, so you have another account over here. So in the absence of partnership agreement, so partners are not entitled. So it means that if you want the salaries to be given to the partner, so it means that you should state in your agreement. Otherwise, you are not entitled. Alright, journal entries, just like normal. Debit partner salaries account and credit bank account. Already paid, not yet paid. Debit the partner salaries and credit partner's current account. And this is if they would like to close the inventory. So later on, I will show you how it's going to affect in the account. Alright, partner's drawing. Just drawing is like normal. So here drawing is done by the partner. So how to record the entries? So we are going to debit partner's current account. But previously we debit drawing. But now we are going to debit current account, partner's current account, and then we credit. Doesn't matter if we took cash, we credit cash. If the partner took purchases or stock, you should take from the purchases. Alright, interest on drawing. So interest on drawing, so why the reason we charge this one? Because to ensure that the partner will only take the drawing is not for granted, right? For example, if they would like to say like here, it's going to be charged from starting the date of the withdrawal to make sure that they would like not to have a much drawing or more drawing in their account. So what will be their general entries is debit partner's current account and credit profit and loss appropriation account. Interest on capital, so it means that here two or more partners contribute to the capital, but there is unequal capital. So it means that A contribute 10,000, B contribute 20,000. So the capital is different. It's about unfair, right? So what they are going to do is they would like to give the interest on capital. So it means that here if you invest more in the partnership, you're going to get more benefit. Alright, so how to record this one? Debit profit and loss appropriation and credit partners current account. Okay, So the previous 5 item is actually you should know how to record in the account. So this is very important because this is the extended of the profit and loss. Alright, so the financial statement, the profit and loss appropriation account. So profit and loss appropriation account is actually after the profit and loss. So net profit appropriated to each partner is shown in the profit and loss appropriation statement. So allocation of profit or loss among the partners in accordance to their profit sharing ratio after considering interest on capital, interest on drawing, interest on loan, and partner salary. Alright, so these are the things that you should know how to record. Alright, so the journal entries you are going to record is debit P&L appropriation and credit partners current account. So if this is the credit side. But about the debit side, we debit partners current account and then we credit P&L appropriation. Alright, so let's say, so this is the profit and loss appropriation statement. So where net profit before adjustment, so this is come from the profit or loss account. Alright, so the profit or loss, the normal profit or loss is like normal. So now we have to extend the profit or loss appropriate statement. So it means that here in this profit or loss appropriation statement is actually how are we going to divide the profit to each of the partner. And please do in mind, interest on drawing we are going to add as the revenue. Why? If the partner is being charged interest on drawing, so it means that here the more partner took the money from the business, so it means that they have to pay interest on drawing. So it means that when the partner have to pay interest on drawing, so the money goes to the partnership. So this is where the profit of the company and plus with the interest on drawing is a benefit to the partnership if the partners took the money. So they have to pay for the interest. And then last, what we are going to have to last is actually what will reduce the profit of the partnership is actually the partner's salary. If they have two partners, partner 1 and partner 2. And then interest on capital. So interest on capital is actually, it will reduce the partnership profit because if they contribute more capital to the business, so the business have to pay the partners more interest on capital. And then interest on loan. They borrow more, they have to pay more. And then what we're going to have here is actually the profit, but the profit should be appropriated profit to partner 1 and partner 2. For example, if they have the profit of 10,000, after we deduct everything that we should pay to the partner, and we have partner 2, for example, profit sharing is half and half, so it means that 5,000 each for the partner. From the 10,000, they have to divide into partner 1 and partner 2, so each partner will get 50,000. Alright, the sharing of profit or loss after all the necessary adjustments, so the resulting profit will be distributed among the partners in the agreed proportion, just like I said just now, 5,000 and 5,000. Alright, in the absence of the partnership agreement, so it means that here if you do not state the profit sharing, for example, you wanted the person who contribute more to get more profit, you should state in the agreement. Otherwise, according to the partnership, the profit sharing should be paid equally. Alright, so illustration 1. So Aina and Najwa is two partners in a partnership. So they have to state the profit sharing 2:1. So it means that here for Aina is 2/3 and for the Najwa is 1/3. Alright, the partnership reported a net profit of 62,000 for the period. So Aina has made a loan and entitled interest on loan of 10%. So how are we going to calculate profit for the partner? So net profit is 62,000, and then they have interest on loan for 20,000, which is 10%. So it means that here, so this is the profit. We have to less first interest on loan, then we are going to pay to the partners. So here, net profit 62,000. We have to minus interest on loan. So how interest on loan is calculated? 10,000 from 20,000. So we have to deduct this one first. Alright, 2,000, and then we have the profit left of 60,000. So how to divide the 60,000 according to Aina and Najwa? Just now the question stated 2 is to 1. So total 2 plus 1 is 3. So this one, Aina will get 2/3 and Najwa will get 1/3. Alright. So 2/3 from 60 will get 40,000. Najwa will get 1/3 of the 60 is 20,000. Right. So this is how the calculation should be in your account. Alright, minimum guaranteed profit sharing. So there are partnership agreement that include a clause that guaranteed amount of the profit for a partner. So it means that here we guaranteed, it doesn't matter which partner, we guaranteed the minimum, so this amount that they should get. So if the particular partner share a profit in a year below that agreed amount, then all other identified partners will cover the insufficient agreed amount from their shares to the residual profit based on their profit sharing ratio. For example, we have partner A and partner B, right? So the profit sharing is equally. So Aina is guaranteed of 1,000. Okay, so if the profit is 1,500, if equally should get 750 each, right? A 750, B 750. But if A is guaranteed for 1,000, what about the profit sharing? They should give like this. A will get 1,000 to give the guaranteed amount. Minimum, this is the amount, the guaranteed that you should pay, so 1,000. So extra is left for B, 500. Okay. So illustration 2, Atif and Hazim are partnership who share profit and loss equally. So it means that equally, half-half. So half for Atif and half for Azim. So Atif has been promised a guaranteed minimum of a profit of 50,000 per annum. Per year minimum, Atif should get 50,000. So any deficiency will borne by Hazim. So it means that any not enough figure, so Hazim will pay. So the partnership reported a net profit of 90,000. So Atif and Hazim. So it's actually half-half, right? So half-half 90,000 is actually 45,000. But in this situation, Atif is guaranteed of 50k. Alright, so this is the scenario. So you are required to calculate. I think that you are able to calculate already, yeah. So net profit 90,000. So Atif will get 45,000, and this one will get 45,000. Okay, so the amount which is not enough is actually 5,000. So we have to minus the 5,000 from Hazim and give to Atif. Alright, it's because the minimum guaranteed is 50,000. Hazim is only to get 40,000. So the total is 90,000. Okay. Alright, statement of financial position. So a partnership statement of financial position is reported the amount of capital and current account balance of each partner. So this is what the difference between previously. Previously we just have capital account, but now capital account we have partner 1 and partner 2. So previously we only have net profit. But now we have current account, partner 1 and partner 2. Loan also we have, if only partner 1, So partner 1. If we have partner 1 and partner 2, we have to state the partner 1 and partner 2. Right? So this is the difference. Right, illustration 3, Hakim and Anas are partners in a partnership business for several years. So the following information was extracted from the partnership book as at 31st March. So here, capital account, April 160 for Hakim and 80,000 for Anas. So current account, so if there is a bracket here, it shows that current account will have on the debit. This is for the credit. Please to remember. Alright, bracket is for the debit. So drawing 6,000, 2,400. Okay, so this is the partnership agreement clauses. Alright, interest on capital 5%. Interest 6% on drawing. Salary 2,000 is only for Hakim. 8% loss from partners. So profit and losses, Hakim and Anas 2:1. And Anas is guaranteed a 60,000 per year. Additional information, so Hakim advanced 20,000 loan to the partnership and then he received salary up to 31st December. Right, and then partnership net profit is 196,000. So you are required, so this is some sort like a final exam question. So you are required to profit or loss appropriation account, partner's capital account, partner's current account, and statement of financial position. Alright, so this is the net profit that we get from the profit and loss. So interest, please bear in mind, the interest on drawing you should add and the rest we should minus. Okay, so have a look here, interest on drawing. So interest on drawing, we can see here the drawing is where is the drawing? Can we see here? Alright, so we get the drawing 6%. Number 2, interest on drawing is 6% on all drawing. So interest on drawing is 6% times with 6,000 times 6/12. Why 6/12? Because the drawing here from 1st October. 1st October, October, November, December, January, February, March. 6 months. Alright, so for 6 months, so this is the reason why we times 6/12. Anas 6% times with 2,400. So 2,400 from 1st January until 31st March. So only for 3 months. So this is for the 3 months. Okay, so here 6% times 2,400 times 3/12, 3 months, and you get 180 for Hakim and 36 for Anas. And then we less partner salaries. Have a look on the question, partner salary. So salary is 2,000 for Hakim only. So 2,000 per month. Alright, 2,000 per month for Hakim. So partner salary is only for Hakim. 2,000 times with 12 is actually 24,000. Next, interest on capital. So this one you have to remember only the 3 item. Alright, so interest on capital. Alright, so the question state interest on capital is 5%. Okay, now we see the capital here. Hakim 160, Anas 80,000. Okay, so interest on capital, Hakim 5% times with 160,000, Anas 80,000. So Hakim 5% times 160, you got 8,000. Anas 5% times 80,000 become 4,000. Alright? So the amount that you should deduct is actually 12,000. Alright, interest on loan, have a look here. Interest on loan is 8%. Okay? From the partners. So, where to get the amount of interest on loan? Additional information. So, Hakim has advanced 20,000 on 1st April. So, at the beginning of the period. So, complete for 1 whole year. So, interest on loan, Hakim, only for Hakim, 8% times with 20,000. Complete for 1 year is 12 over 12. So, don't need to write. Alright, so you get 1,600. So this 196,000 you plus with interest on drawing, right? And then you minus with salaries, 24,000, interest on capital, 12,000, and interest on loans. So you left off 158,616. And then how to distribute the profit among the partner? So Hakim 2/3 and Anas is 1/3. So times with the amount that you left is 158,616. You got this figure and this figure. Okay? But according to the question number 5, is the profit guaranteed 60,000? Alright, Anas. Anas is guaranteed a 60,000. So in order Anas to get the 60,000, what you should do? So 52872 is not equivalent to 872 is not equivalent to 6,000, which is not enough of 7128. So the 7128 is actually you should get from Hakim. You minus from Hakim 7128 and then you add to Anas. Okay, so now the profit sharing after you calculate 68616 and 60,000 for Anas. So what about the capital account? So it means that here Hakim 60,000, Anas 60,000, balance CD. Balance BD at the beginning also the same. What about the partner's current account? So if we see that the balance BD, this is debit side 3,600, this is 8,400. Interest on capital, just now we said that we add, so this one we debit. Accrued salaries is only for Hakim, we debit. Interest on loan is only for Hakim. And then the appropriate profit, we already calculate before. And then drawing, we put it over here. Interest on drawing over here. And then we calculate for the balance CD. Okay. So the financial statement or financial position, the difference is only in the capital account and also the current account. The loan also should state the name, that is the different. The rest are the same with our statement of financial position. Thank you.